Now we have like first strategy is long call. Long call means you are simply bullish with the market and you believe that market will go up. So this is a naked option strategy, which is long call. In which in the long call we have the unlimited profit and with the limited loss of the premium. Same way we have short call. Short call is also a naked option strategy in which we believe that market should either bearish or it should be range bound. So we sell the call option and receive the premium, and if the market remain bearish or remain below your break even point, then we will make a limited profit, but there are chances that can be a limited loss. That is known as short call. So this is also a naked option. Third strategy we have got about long put. Long put means when we are bearish with the market. Okay. Then again, this is a naked option without doing any kind of hedging. So if you are bearish with the market, you just buy the put option. You choose a strike price and pay the premium. If the market is going in your favor, then you will make unlimited profit with the limited loss of the premium you are paying. Same way, fourth option we have short put. Short put, when we believe that the market is going to recover from a good support area, then instead of buying the call option, we can go for short put. So if the market is bullish and if the market is not breaking your support or the strike price you have choose, you make limited profit with the unlimited loss. So these four are the naked option strategy in which we are not doing any kind of hedging. Other two strategy we have covered is synthetic long call and synthetic long put. So synthetic long call, simply it is a made of two strategy combining two underlying asset. So this is a hedging strategy in which we just buy the stock, and to hedge that particular position, we buy the put option as well. So buy the stock in the cash market, and along with that, for the hedging purpose, we have used a put option. We just buy the put option. Okay. Another strategy we have covered with synthetic long put, in which we do sell the stock, and that can be done in the intraday only. If you are choosing the stock, or if you are selling the future, that can be used for monthly purpose as well. So in that particular strategy, you just sell the stock and buy the call option. Other two strategy for the same kind of underlying asset with the cash market or with the future you can do is covered call and covered put. So today we will learn about covered call. Covered call, and we have covered put as well. So in the synthetic long call, what we have done, we have buy the stock. The synthetic long
and
call, we have buy the stock and buy the put.
yes,
Buy shares and buy put. Okay. Buy share and buy put. But in the covered call, what we will do, we will buy the share and sell the call option. Instead of buying the put option, we are just selling the call option. When we sell the call option, we will receive the premium, and we
yes,
will receive the premium. So in case the trade is not going in your direction, okay, so we can, if the trade is not going in your direction, so the amount you receive from selling the call, that will hedge your position in the downward direction. If the market is going in downward, so whatever the loss you are bearing in this particular share in the cash market, this call writing will give you a limited protection, not unlimited protection, but it will give the limited protection. Okay. So let's see with one of this example. So suppose that Mr. XYZ, Mr. A buy the stock XYZ, and that is trading around this area 3850. This is the spot price. Okay. This is the spot price. So he buy the stock. So obviously he is bullish with the market. So he's bullish with the market and he believes the market will go up. That's why he's making lots of investment in the cash market. To hedge this position, what he is doing, just selling the out of money call option. So we can choose an any strike that what we feel that there would be a strong resistance over there. So if the
okay,
market is not going to cross that particular level, so for example, market is trading around 33850. So we have choose the strike price of 150 point above. Believe that this would be a strong resistance. That market is not going to break that particular level in the upside direction. Okay. So when you sell this call option, you will receive some kind of premium. In this case, we are receiving the premium of 80 point. Okay. So we have buy the stock at this price. Okay. So if the stock is going in your direction, in the upward direction, obviously baat hai, you will make the profit. But if the stock is not going your direction, it is coming down, then you have to bear some kind of loss. So what will be the your hedging? At what is the level till that you are not going to face any kind of loss? That will be your break even point. So we receive the premium of 80 rupees. So if you minus 80 point from this, the value will come like 3770. That will be my break even point. So we hope that the market will go up, but in case the trade is not going in your direction and is the price of the stock is falling, so till this value, till this point, you will not have to bear any kind of loss, because the premium you have received, you have to pay back that particular premium. So that will hedge your position up to this point. But because on selling the call option, we receive the limited premium. So this is the limited premium we have received. So it will give you a limited protection in the downward side. So that is my break even point. After this break even point, if the stock will fall further, you have to bear the loss, and that will be a limited loss. Okay. So what we can see is that this is my profit and loss table. Okay. Now you can see 30, we have choose the strike price of 380. In the cash market, we have choose 3850. Okay. So this is 3850. On reaching 3850. Okay. So here you will get the profit of 50 point in the cash market. Okay. Here you will get the profit of 100 point. Oh, sorry, 150 point. Here will be 150 point. Here will be the profit of 250 point. And here you will get the profit accordingly 350 point and so on. In this time, if the stock price is falling, so you will have to bear the loss of 50 point here, then so on. Now you have received the only limited premium. You have received the premium of 80 point only. Okay. So if the stock is going in the downward, then we can do on the like Excel. That will be more comfortable. So I'm going to Excel sheet. Then we'll apply this on the real time chart as well. Okay. So we have the buy the stock buy at 3850. Okay. Let's assume that the let's assume that the lot size is 50. Okay. So lot size is 50. To buy the stocks, 50 stock, you need to pay the amount is this one multiply by this one. Okay. Now at the same time, we have sell call of strike price of 4000 and receive the premium of 80 point. Okay. And amount would be 80 multiplied by 50. The premium received in amount would be 4000. Okay. Now what will happen? The payoff break even point would be would be 3850 minus 80 equal to 3770 would be my break-even point. Okay. So if the stock is going upward direction, like 3850, no, 38, 3900, 50 point above, 3950, 4000, 4050, 4 and 4200. Okay. So in this case, you will make the profit of at this time we will not make any kind of profit. In this case, we'll make a profit of 50 point in the cash market. Here would be the profit of 150 point. Here would be the profit of 200 point, then 250, then 300, then 350, then 400 point profit. In case the stock is coming down, 3800, 3750, 3700, 3650, or 3600. Okay, now you have to bear the loss of 50 point. Now 100 point loss, 150 point loss, 250 point, and 300 point. So if the stock is falling down, obviously you have to bear some kind of loss. Now, if the stock is coming upward direction, now we have the call option of 4000. Now 4000 is my call option. Okay, and for that I have paid the premium of 80 point. So I select this thing. Okay, for the call sold of 4000 strike price. So this is the payoff of cash market. Okay, so if the market remain below 4000, you will make a profit of 80 point here. If the market close below 4000, you will make a profit of 80 point, and that will remain same till this point. Okay, when the stock is coming at this level, okay, the intrinsic value of would be like 80 minus 50. Intrinsic value would be 50, but we have received the 80 point, so still we'll make a profit of 30 point, plus 30 would be my profit. In this case, there would be the loss of 100 point, but we receive the premium of 80 point, so still there would be the loss of 20 point only. Okay, in this case we will make a profit of 150 point. Oh, the value, intrinsic value of the call would be 150 point. We receive the 80 point. So if you minus 150 and 80 point from that, you will make a loss of 70 point. So these would be loss, this would be the loss, again this would be the loss, and this is the positive value. Now the stock is coming upward direction. Oh, sorry. Yes, okay, it's perfect. Okay, now because we have sold
400 minus 80.
yes, okay. Now intrinsic value of the call would be this one. We have received the premium of 80 and the loss would be 120 point. Okay.
Yes.
Now what will happen? So you will see on reaching this, like we have received the 80 point here as well. Okay. So 200 plus 80 would be your profit, like 280 point would be your profit. Again 250 point plus 30, like 280 is your profit. Now we are making a profit in the cash market 30 point, and we are making a loss of 20 point. Now again you can see there would be a profit of 280 point.
Yes.
Now again we are making profit of 350 point, but 350 minus 70, again it would be 280, and again 400 minus 120 equal to 280. Now on the downward side it will give a limited protection. Okay.
Yes,
now you can see in this case you are making a loss of 300 point, but we have received the premium of 80 point. So 300 minus 80 equal to minus 220. There would be the loss of 220 point. Now you can see again in this case we are receiving the premium of 250 point. We'll make a loss of 250 point and 80 would be there. So 250 minus 80 equal to minus 170. Minus 170 would be my loss. In this case, the loss would be only 70 point. In this case, the loss would be only 20 point. In this case, we are making a loss of 50 point, but we have received the then 30 point would be my profit. Again, in this case, I'm making a profit of 80 point because stock value is 0. There is no profit in the stock, but we receive the premium of 80 point, so 80 will remain constant. In this case, we are making a profit of 50 point in the stock and 80 point in the call writing. So again, 130 point would be my profit. In this case, you are making a profit 150 point in the cash market and 80 point in the, so again, it would be 230. Now you can see until the stock is not crossing this level, you are making a good profit because we are making profit in this as well and in this as well. On reaching above this value, now you can see you will get a profit in this, but you have to bear the loss in this because we have sold the call. Okay, so that's how you can make this strategy, and you can see you have a limited profit. Okay, so what you can do if the stock is coming upward direction, what you can do, you have two options. Either, for example, if the stock is going above this value or going above your break-even point for this individual stock call option, the break-even point would be 4080 for this call sold. So if the stock is going above 4080, what you can do, you can continue with this strategy, square off your position in the call writing and choose the another out of money call option and sell the another strike price of 4200 or another out of money call option, and again receive the premium and continue with your trade. Other option what you can do, you can square off your position in the call option and continue with the cash market. Continue your position in the cash market. Or if you want, you can exit anytime because your maximum profit will remain constant. So if the stock is going upward direction as well, you can see your profit is limited. So if the stock is going upward as well, your profit is not increasing. So it is better either you should square off your position and take the position and take the profit whatever you are getting, because if the stock continue to rise, so you will make a profit in the stock market, in the cash market, but you will have to bear the loss in the call option. So it is preferable when you reach your threshold point, that is the maximum profit you will get. At that time, you can exit. For example, you can exit at this point because here we are having the maximum profit.
Wherever we have done the shorting,
Yes,
if
yes,
the spot price reaches that level, then we can
yes,
come out of the
yes.
position.
Second
Call.
option, I have told you what you can do. You can come out of that particular call writing. For example, we have write the call of 4000 strike price. What we can do, we can square off your position and again choose this strike price,
Okay.
4300 strike price, and again sell the call of this particular strike price and
Oh,
receive the premium.
okay.
Okay. So if the stock will continue to grow, continue to bullish, continue to go in the bullish direction, you will make again hedging or will continue with your trade. Okay.
Yes. Sir, but when the stock is keep on rising,
Yes.
in between the expiry, in between the month, if when I am trying to when the spot price is at 4,000, then the time value will also be there in there, no sir, in the
Yes.
premium.
Yes.
So,
Exactly.
okay,
So according to the theta, according to the time value,
sir,
what will happen? The 80 point will become, if the stock is not going in the upward direction. If it is
sir,
not going the upward direction, the time value will affect the premium. So
yes,
it
sir,
will decrease. Maybe
yes,
after
sir.
a few days, it will become 70, it will become 60, it will become
Okay,
50. Okay. So on the day of expiry, if the market close below that level, that
yes,
will become 0.
yes,
So
sir.
we have sold at this value and we will retain all the premium So
Yes,
80 point would be your profit. But in case the stock is going in the upward direction, the
Yes.
intrinsic value will also apply, and the time value will decay the premium, but the
Yes.
intrinsic value will increase the
Increase.
premium.
Yes,
So
sir.
in that case, there would be some kind of uh,
Loss.
intrinsic value would be for that.
Yes, sir.
So if the expiry is coming close and the uh, strike price or the spot price is around this,
Yes.
then what would be the intrinsic value? Intrinsic value would be
100
around
rupees will be the
yes,
intrinsic
yes,
value,
it
sir.
is close to the 100.
Yes,
Okay.
sir.
So what we can do that when we are believing that the stock is going now, we are very bullish with the stock, so we can exit from the this particular strike price which we have sold, and we can book your profit or whatever the loss is there. Okay, and we can sell another out of money call option and receive the premium for that.
Yes, sir.
Okay. Now coming to this strategy on the, we can do this thing on live chart as well or intraday as well. So what you can see today is market is more than 260 point plus, and
Yes, sir.
also the Sensex is more than like 700 or something point plus.
Yes.
So yes, it is almost 950 point plus Sensex. Okay, you can see 964 point plus today. Okay, now coming to the top gainer. Okay, so coming to market data, and we are choosing gainer and the loser, and we can choose any stock. Like we are today, all the IT stocks were bullish. So Kotak, oh, Tech Mahindra is there, TCS is there, Infosys is there, and SCL is there. So out of 10 stock, 4 were from the IT sector. You can see on the heat map, Tech Mahindra one of the leader today. Then TCS is there, Infosys is there, and SCL Technology is there. Infosys is there. So IT sector was one of the booming sector today. So we can choose this particular stock, Tech Mahindra, or we can choose any other stock as well. We can choose TCS as well. Okay, so we can choose TCS as an example. Now TCS is 65 point today, and on the opening, the price was 2225. Okay, now we are making the same strategy with TCS today. So TCS, okay, we are considering right now the opening price. So 2225 is the open price today. Okay, and lot size of TCS
170, sir.
170.
Yes, sir.
Okay.
Maybe one. You can check. Maybe it would have changed.
Now in this case, you have to pay the more margin for that because we are
Yes,
writing the call as well.
yes.
225 is the lot size.
220.
Okay. So 225 is the lot size. To buy the 225 share in the cash market, we need to pay the this one multiply by this one
Nearly
equal
5
to
lakhs.
nearly 5 lakh, right? But in the future, you can make same position in 80,000 only.
Yes.
Okay. The same thing can be done with future as well. Okay. This is for cash market and this is for future. So you have both options. You can go for cash market as well. You can go for future as well. This is the premium you are paying for this. Okay. Now, along with that, we have to write the call option as well. So what we can do is okay. So we can choose either like 2400 strike price, or we can choose like 2340 as well. Not a problem. Okay. 2340, or I can choose 2400. 2400 would be an ideal Okay.
Sir,
So what?
this shorting,
Yes.
uh, the, sir,
Yes. Yes.
the shorting, the shorting one. How do we choose the strike price, sir?
See, it should be out of money. Now,
Okay.
for example, like the strike price on which you should consider as a stiff resistance. Okay. So in this case, you can see the OI showing that it is 8,300 something, and the second most OI is at this price. So that can be easy to achieve, but this would be hard to achieve. So that's why you can choose either this strike price or this strike price. So we have in the time to expiry still 10 days to expiry, so we can choose this value as in for selling the call option 2400. Okay. On you can see the chart as well. So if you see the TCS chart and on the daily basis, if you can see, you need to see an area where you can see a resistance. So you can see there is a resistance here as well. There is a resistance here as well. This is 2400 around. This is the area of resistance around this. Okay. So on this particular candle, on the high of this particular candle, I can place a resistance. So it is around 2400. Okay. That's why I am choosing this strike price. Okay. So this is my area of resistance, like this point 2400. Okay. Here. Or the third one is 2300. 2300 is very close to. That can be a break, that can be broken. Okay. So we have to choose that a strike price which is what you can say, like it should not cross above that level. Okay. So it should be either out of money, slightly out of money, not too far away from the current price. So that's why I have choose 2400, or you can choose this strike as well. So if you choose this, you will get less premium. If you choose close to the ATM, you will get the high premium. So for example, if you are choosing this, you will receive the premium of 23 point. If you're choosing this, you will receive the premium of 10 point only. Okay. So for example, if I'm choosing this strike price, what will happen? I will receive the premium of, in the morning, the price was around 13 point. Okay. So 13 point premium I have received for 2300 strike price. 2300 call option. Call sold. Okay. Now we have received the only 13 point. Okay. Now what will happen? The lot size is 225. So what will be the premium? Premium would be this one multiplied by this. Okay. So now you can see this is the premium you are receiving. And what will be the break even point? So 2225 break even point would be this one minus this one. Okay. So that will be your break even point 2212. So if the stock is go below this, you have to bear some kind of loss. Now what will happen on the day close or close to the day, the strike value of this strike price is 23. Okay. So 13 point become 23. So you have to bear the loss of 10 point. Okay. Difference of this would be 10 point, and 225 multiplied by 10. This will be a loss in the call sold. Okay. So this will be your loss. Now spot price of this is right now, or at the time of closing, is 2266. Okay. 2266. 2266. Now difference is this one minus this one equal to 41 point. So you are making a profit of 41 point and having the loss of 10 point. So still you are making a profit of 31 point. Multiply by the lot size. Okay, 31 point. And if you multiply this with the lot size, this would be your profit for the intraday. Okay, that's how you can make this position in the intraday only. And for writing the call option, again you have to choose the option, and 23 strike price, you have to sell the call option. Now total investment would be 1,06,000, because we are selling the call option, so we have to pay premium for that as well. Okay, so in that case you are receiving the premium of only 2,300. Okay, and in this case we are having the loss in the call option, because the stock TCS price grow is bullish today, so that's why we are having the loss in the stock. In the call sold, the value of this, the premium increased from 13 to 23, so we are having a loss of 10 point. But in the cash market or in the future, we are making a profit of 41 point. So if you minus 41 minus 10 equal to 31 point, so in the intraday you could have make a profit of around 7,000. Okay, now if you carry this position for the next few days, or if it is a swing trade, you can wait and you can continue with the same position. Okay, if you want, you can continue in this strategy. So maybe it may possible that tomorrow the stock will again gap up. Okay, open at a gap up, or it should open around 2,300, or maybe or may not be. Okay, so the price of the underlying asset will increase, then you will have the profit in the cash market, or if it is a future contract, they will make a profit in the future, but you have to bear the loss in the call option as well. So that's why we have to choose either close to the, okay, so if you want, you can choose this strike price as well. If you want, you can choose that strike price as well. Okay, so in this case the premium is 30 point, in this case the premium is only 6 point. So it will give you only 6 point hedging, it will give you the hedging of 30 point. This is the main difference. Okay, and you can see we are having a limited profit and the limited loss. Okay, so if you are having the high premium, that will protect you more in the downward direction. So if you are receive the premium of 30 point, it will give you the protection up to 30 point in the downward direction. The stock is not going in your direction. If you receive the premium of only 7 point or 10 point, it will give you the protection of only 10 point. So if the spot price is 2260, so break even point will be very close. It will be 2250 only. So that's why we should choose the strike price in which we have a decent premium, so that it can protect you in the downward direction as well. But if you are very bullish with the stock, you can choose out of money as well. There would be no problem. Okay. So if you want, you can wait for this trade for delivery as well. You can choose for the swing trade as well. You can hold till expiry as well. It's all up to your choice. And if you want to do the intraday trading only, you can choose any stock which is good for the intraday purpose. So for example, TCS was bullish day, so we have choose TCS. Same thing we can do with the Jio as well. Now you can see another stock was bullish, was Jio Finance. Gainer, we have Jio Finance as well, and we have Kotak Bank as well. Okay, the same thing you can choose with Kotak as well. So first of all, you need to check that Jio Finance or Kotak Bank is bullish today or not. Okay, so we can choose
Sir, like sorting the call, we can select the strike like first we have, can we check ATR, average to range of the stock in a month? then we can decide which strike price we have to short the call.
No,
Can
no,
we do like this?
it's all up to your choice. You can choose any strike price, but if you are choosing slightly out of money, that will be better.
Slightly out of money means delta value should be for 0.4 like this.
Yes, yes, 0.3 as well.
Okay, sir. Up to maximum 0.3 out of
Yes,
the money.
yes.
Okay,
So we can choose Kotak now.
okay, sir.
So if you are doing this for intraday only, we have to choose the stock in which we are bullish. For example, this Kotak stock.
Sure.
Okay. On the 15-minute time frame, you can see the stock was bullish.
Sure.
Okay. This is my first candle. This is my second candle and the third candle.
Yes.
So the stock is continuously making higher high and higher low.
Yes,
And
sir.
this is my first 15-minute candle. Once the stock cross above this, you can go for a buy trade. Okay.
Yes, sir.
So at around this point of time, like 380 would be my entry level, and the stock
Yes.
close, you can exit at this point as well. You can exit at this point as well. If you make an entry at 380, 390, there would be a 10-point profit. Okay. Now say you can for Kotak Bank. Okay. Now 380. So stock was at around 380 in the morning. Okay. And it reached up to 390. Okay. So there is at least 10 point. You can choose any strike price like 10-point difference. Okay. The stock in the morning was around 380. You can choose a strike price of 390 or you can choose like 400. Okay. Now on the this OI data, you can see the maximum open interest is 49 and here is 6,000. So this strike price having the maximum OI, that means that stock should not cross above this level. Okay, there should be a stiff resistance. The
Okay.
Kotak stock should not cross above 400 in this particular month, according to the data till now we are having.
Okay, sir.
Okay, so that's why you can choose either this stock, this strike price, or you can go for this as well. If you would have choose this one in the morning, it was around 4, maybe, yes. It opened at 4 and closing price is about 4 point. So in this trade, you will make you have to bear the loss of 4 point, but in that particular future contract, we will make a profit of 10 point. So 10 minus 4 equal to 6 point. You will make a profit of 6 point. And 6 point according to the lot size 2000. Okay, so we have a lot size of 12 or 2000. So you would have make a profit of 12,000. 12,000 would be your profit if you do for intraday only. Okay, so that's how you can use this strategy for intraday, and if you want, you can continue to hold this for the next few days as well. You can use this as a swing trade as well. Now you can see the stock is reversing from this point. Okay, now we can place a FAB tool here. This is my high and this is my low, and it has already crossed the 38% level. Okay, so it may possible you will see the bullishness in the stock tomorrow as well, and this would be my first target. So it can reach up to 400 as well. Okay, because that's crossed this 38%. That's when that is a good support area would be here. Okay, so that can be the possibility for this, and so if you want, you can hold this stock for swing trade as well. And again, you can see it has recovered from 61%. Okay, so this is my low, this is my high, and if you see the retrace, so it is got the reversal from this 61% area. Okay, so this is a good sign. This is my golden ratio. From this, my golden ratio, the stock has recovered, and if I apply this FAB tool from this to this, it has already crossed 38%. So we can expect it can come up to this level, I think. So if you see the bullishness continue in this particular stock, then you'll see tomorrow as well, the stock will, no, tomorrow would be Saturday, the market will close. So if the things remain positive on Monday as well, so you will see the stock will be in the bullish direction as well.
Okay.
Okay. So this is your covered call. In the next class, we will cover
Okay.
covered put as well. So
Thank
can we have class tomorrow as well?
Yes, sir. Sure, sir.
Okay, okay. At the same time, we'll continue
Okay.
with that.
Thank you.
Okay.